Hello and welcome back to the Babalian Money Show, your go-to place for making sense of the world of finance. I'm your host, and today, we're re-tackling a question that trips up a lot of new investors. What is the real difference between index funds and ETFs? You've probably heard these terms thrown around, maybe even used interchangeably. But are they the same thing? Not quite. By the end of this video, you'll understand exactly what sets them apart, how they work, and which one might be the better fit for your investment strategy. So grab a coffee, get comfortable, and let's dive into the great debate, index funds versus ETFs. Before we get into the details, a quick but important disclaimer. I am not a financial advisor, and this video is for educational and entertainment purposes only. The world of investing carries inherent risks, and you should always do your own research or consult with a qualified professional before making any financial decisions. Your financial situation is unique, and what works for one person might not work for another. All right, let's get back to it. First things first, let's break down what an index fund is. Imagine you want to invest in the stock market, but picking individual stocks like Apple or Amazon feels overwhelming. An index fund offers a simple solution. It's a type of mutual fund that aims to replicate the performance of a specific market index. The most famous one is the S&P 500, which tracks the 500 largest publicly traded companies in the United States. So, when you buy into an S&P 500 index fund, you're not buying one stock. You're buying a tiny piece of all 500 companies in that index. This strategy is called passive investing. Instead of having a fund manager actively trying to pick winning stocks to beat the market, the fund simply mirrors the index. This hands-off approach is why index funds are famous for their incredibly low fees, or what's called an expense ratio. You get instant diversification across a huge swath of the market without the high cost of active management. So, how does an index fund actually work? Let's say you invest $100. The fund manager takes your money, combines it with money from thousands of other investors, and uses that giant pool of cash to buy the stocks that make up the target index. They buy them in the exact same proportion as the index itself. If Apple makes up 7% of the S&P 500, then roughly 7% of the fund's assets will be invested in Apple stock. The beauty of this is its simplicity. If the S&P 500 goes up by 10% in a year, your investment in an index fund will also go up by roughly 10%, minus the small expense ratio. You're essentially riding the wave of the overall market. The main thing to remember about traditional index funds is how you buy and sell them. You can only trade them once per day after the market closes. The price you get is the fund's net asset value, or NAV, which is calculated at the end of the trading day. This isn't a big deal for long-term investors, but it's a key difference we'll come back to. Now, let's turn our attention to ETFs, which stands for exchange-traded funds. Here's where it gets interesting. An ETF can also be an index fund. In fact, many of the most popular ETFs like SPY or VU are S&P 500 index funds. So, an ETF is a type of fund that holds assets like stocks or bonds, but it trades on a stock exchange just like an individual stock. Think of it as a basket of securities that you can buy or sell throughout the day. This is the single biggest difference between an ETF and a traditional mutual index fund. While a mutual fund's price is set once at the end of the day, an ETF's price fluctuates all day long, just like a stock. You can buy it at 10 a.m. and sell it at 2 p.m. for a different price. This intraday trading gives investors a lot more flexibility. You can use advanced trading strategies like limit orders or stop-loss orders, which you can't do with a mutual fund. So, an ETF combines the diversification of a mutual fund with the trading flexibility of a stock. So, if many ETFs are also index funds, what's the point of the distinction? It all comes down to the structure and how you trade them. The term index fund typically refers to the traditional mutual fund structure we talked about first, the one that trades once a day. The term ETF refers to the exchange-traded structure. So, You can have an S&P 500 index mutual fund, and you can have an S&P 500 index ETF. They both track the same index and hold the same stocks, but they trade differently. It is like having two different models of a car that have the same engine, but different body styles and features. One isn't inherently better, they're just built for different kinds of drivers. The ETF structure also allows for funds that track all sorts of things beyond broad market indexes like specific sectors such as technology or healthcare, commodities like gold, or even bond markets. This variety is a huge draw for many investors. Let's do a direct head-to-head comparison on a few key points. First up, trading and liquidity. As we've established, ETFs trade like stocks throughout the day. This is great if you're an active trader or want to react quickly to market news. Traditional index funds only trade once per day at the closing price. For a long-term set-it-and-forget-it investor, this difference might not matter at all. In fact, it might even be a good thing, as it discourages impulsive trading based on short-term market noise. So for flexibility, the point goes to ETFs. For discipline, long-term investing, it's more of a tie. Next, let's talk about minimum investment. This is a big one for new investors. Traditional index funds often have a minimum investment requirement. Now for a slightly more technical but important point, tax efficiency. In a taxable brokerage account meeting, not an IRA or 401, KETFs are generally more tax efficient than traditional mutual funds. This has to do with how they are created and redeemed. With a mutual fund, when a lot of investors decide to sell, the fund manager might have to sell some of the underlying stocks to raise cash to pay them. This can trigger a capital gains tax event, which gets passed on to all the remaining shareholders in the fund, even if you didn't sell anything yourself. It's not fair, but that's how it works. ETFs have a unique creation and redemption process involving authorized participants that avoids this issue. It's a bit complex, but the bottom line is that ETF investors have more control over when they realize capital gains, which typically only happens when they sell their own shares. So, for investors using a taxable account, ETFs often come out ahead in the tax department. So, which one is right for you? Let's try to simplify it. You might prefer a traditional index fund if you are a true long-term buy and hold investor and you want to automate your investments. Many mutual funds make it very easy to set up automatic monthly contributions from your bank account. This is a fantastic way to build wealth consistently through dollar-cost averaging. If you're the kind of person who might be tempted to panic sell during a market dip, the once-a-day trading of a mutual fund can actually be a form of protection against your own worst impulses. It forces you to slow down and think. Also, if you're investing within a retirement plan like a 401k, you'll often find that your only options are traditional mutual funds anyway, and they are a perfectly great choice in that context. On the other hand, you might prefer an ETF if you want maximum flexibility and control. If you like the idea of being able to buy or sell at any point during the trading day, ETFs are your answer. If you're restarting with a small amount of money and the high minimums of some mutual funds are a roadblock, ETFs are far more accessible. The potential for better tax efficiency in a taxable account is another major plus for ETFs. And if you want to invest in more niche areas of the market beyond the big, broad indexes, like robotics, clean energy, or emerging markets, the universe of ETFs offers a much wider selection. For the modern, hands-on investor, ETFs often provide the perfect blend of diversification and trading power. To recap the great debate, index funds and ETFs are both fantastic tools for building a diversified, low-cost portfolio. The main difference is in what they invest in, since many ETFs are index funds, but rather their structure and how they trade. Traditional index mutual funds trade once per day, can have high investment minimums, but are great for automated, disciplined investing. ETFs trade all day like stocks, have low entry points, are generally more tax efficient, and offer a wider variety of investment options. There's no single best answer. The right choice depends entirely on your investment style, your goals, and your personal preferences. The most important thing is that you understand the difference and choose the tool that best fits your journey to financial freedom. Thank you so much for joining me on the Babalian Money Show today. I hope this cleared up the confusion between index funds and ETFs. If you found this video helpful, please give it a thumbs up. It really helps the channel grow. And if you haven't already, make sure you hit that subscribe button and ring the notification bell so you don't miss our next video. We've got a lot more financial topics to break down for you. Got a question or a topic you'd like me to cover? Drop it in the comments below. I read every single one. Thanks again for watching, and I'll see you in the next video.